Hello, everybody. My name is Bob Klepsis. I am president of All-Star Financial, welcoming you to the All-Star Financial Quarterly Review, first quarter 2012 webinar. Our title this quarter is Cautious Optimism Amid Slow but Steady Growth. Before we dive into the meat of the presentation, I want to talk just real briefly about a paradigm shift that we believe is happening as we go today. We really believe that over the next 30 years, things will change with how you need to manage money based on a 30-year decline of interest rates. So this paradigm shift you've got to be aware of it in order to take advantage of it and to make sure that you're changing and we're changing the way we manage money over this next time period. Bond yields have declined from 16% to 1.5% over a 30-year time period. The yields have averaged almost 7%, with total return over 900%. We all know that when interest rates go up, bond values go down. We believe we're going to see a secular rise in interest rates over the next 25 to 30 years. So in addition to the smaller worldwide growth with lower equity returns, interest rates going up is basically going to give us less total return for every dollar that we have in bonds. So our belief is that you'll need to have more equity as a percentage of your total portfolio in the allocation in order to retire at your same level from a goal perspective. So if you look just in the past, and the yield plus capital appreciation equals total return equation, that if we've had approximately 7, 8, 9, 10% total returns over the last 25 to 30 years, we believe those returns are going to be less in the next 25 to 30 years. We think 5% on our income portfolio is realistic, 6% balance, conservative growth 7, and growth 8. The thing we want to focus on here is look at the yield component of the total return. In the past, for an income portfolio, approximately 71% of your portfolio you received from, in the total return, you received from the yield side of that equation. We believe that's going to shrink to about 50%. In our balanced portfolio, it was typically about 50. We think that's going to shift down to 33. Conservative growth, 33 down to 21%, 20% down to 12% on our growth portfolio. So you're going to have more equities in your portfolio, which kind of seems strange, but you're actually going to have to be more aggressive now with your asset allocation. Now, that being said, there are ways to reduce that risk, and we'll talk about that with you when you come in on your meeting. Market overview real quickly. We've had the best first quarter since 1998. European restructuring of the debt. They took $1 trillion of financing on the European Central Bank and promised that. U.S. Fed promised lower rates. The help of support of employment, the help of housing, and the help of the flow of credit was really what they're trying to emphasize there. Unemployment rates down. We had 730,000 new jobs in the last 3 months. That's obviously a very good positive. Corporate profits still growing, though they're slowing. And again, make sure we understand that slowing part. Could we be ready for a correction? I think the numbers are there, that the answer is potentially yes. U.S. economy kind of numbers-wise, what did we see for the first quarter? Fourth quarter GDP was positive at about 3%. Again, that's a nice growth rate relative to 0.4, which was the first quarter of last year. Business and consumer spending was a large part of that. Capital equipment spending was up 9%. Business spending, as we talked about. Consumers weighed in on the equation too, also spending about 4% more year over year. And inflation rates stayed low with interest rates low. Those are all very, very positive things in the economy. Manufacturing and service sectors expanded, but the growth, again, has slowed there going forward. The only really bad thing that we look at is really housing prices have still kind of come down. So we're looking for that housing bottom, which may not be for a while. If we look at the U.S. economy looking forward, however, it's really difficult to really maintain the numbers that we've seen. We think business spending and investment is projected to shrink from about 9% to 6%. Corporate earnings are expected to moderate, not necessarily go down all that much, but not grow as fast. And really, when you look at it, jobs will still be the key. Can they continue to grow with those low interest rates and low inflation? It does give us a favorable environment. So all of that being positive, but the real big thing that we think is in this quarter, there's a potential for severe recession in Europe, slower growth in China, that unexpected rise in inflation maybe on the home front could equal to more uncertainty for the United States, which again would not be a positive thing. Bond market. What happened in the bond market going forward? Or recently, the U.S. basically and central banks have kept interest rates low as we've seen them for a long time. Corporations issued $400 billion in debt in replacement of a lot of debt, but also basically to fund new projects, which is good, at a very, very low interest rate. And emerging high yield and corporate bonds basically benefited from that. On the other side of the equation, the U.S. Treasuries really did not, as interest rates went up a little bit. Government bonds go directly the opposite way, so that was obviously a negative scenario for a lot of people that use bonds as their safe haven. So bonds looking forward, again, as long as there's monetary easing, we're okay. It's if inflation rears its head that it could be ugly. We don't think that chance is good, as far as right away, and not likely to happen. Floating rate bonds is really, bank loans, and inflation protected bonds are the tools that we will be using going forward in this paradigm shift to, again, make a little bit more money yield-wise than we can when rates are so low. Domestic stock market, how well did we do? Well, there was really a rally that was based on less uncertainty. The Russell 3000, which makes up 98% of the total value of the United States, was up 12.9%. Large caps were up as much as mid caps at 12.9 also. Small caps 12.4. Growth outperformed value 14 to 11. Financial sectors and technology were probably the top performers. And probably the best thing is that valuations are still relatively low compared to historical averages. What do we think going forward? Despite the gains, again, we have caution going forward. There's profit margins, again, that are leveling off. Financial and technology sectors still look good. Small caps are probably the best buy, with dividend stocks coming back into favor, we believe, more and more as the years go by. International-wise, the emerging markets finally bounced on the value and growth. They were significantly better valuation than the U.S. from a buying standpoint, and they have much more growth potential than the U.S., and it finally bounced. Emerging markets pulled back recently, but they were up as much as 17-18%. They pulled back to a positive 15% for the quarter. Germany and India, an established European country and one of our BRIC nations, did plus 20%. European markets on average were about 12%, so they kind of matched the domestic market, even though European countries have more debt concerns than we have. And kind of everybody, all boats rose with the tide. Even Japan was up 11% with really no real great economic figures or numbers coming forward out of Japan. International stocks looking forward, the euro chance for recession is really the key. Will the government's cuts magnify the recession in Europe with all the austerity measures that are going on there? China's in a transition from really an export to U.S. and other countries to basically providing more of its product to its domestic population. And China also has some leadership changes that they're looking at, too, from a government standpoint. Slower GDP growth from 10 to 12% down to 7 to 8, still really good. The big question there is there a soft landing potential? And we believe the answer is yes. We don't think there's going to be a recession in China. So summarizing really quickly here, we've had really back-to-back good quarters domestically, and that I think equates to a need for caution. We think Europe avoids recession or falls hard That's a question that is yet to be answered. The answers are getting a little bit better as funding to the European nations is a little bit more secure. So we are cautiously optimistic. The positives that we see really are accelerating jobs, as we've talked about, improved economic indicators, stability in the debt markets, favorable business environment is, interest rates low and inflation low. You want to be a business owner, and record profits and increasing dividends. Those are all things. The other thing that we really like is that equities are unrepresented in portfolios. A statistic that we just saw the other day is that $160 billion went into bonds the last 12 months, while 115 went out of equities. And we're here telling you that you need to do the opposite. So really we think there's a lot of investors that are going to be whipsawed by the fact that they're putting money into bonds at really the wrong time. Some of the negatives that we see going forward, frequent downward revision in interest rates or economic data, that's happened numerous times. It happened with the GDP. First quarter of last year, it went from 1.9 to 0.4. So those are always questions in the back of our mind when we're trying to make decisions. That's a negative. Mild winter. It looks like maybe the buying started earlier because of the mild winter. So that's kind of a little bit of a head fake. Our economy is not growing quite as fast as we might have thought. And we still have some debt issues in Spain, Portugal, and Italy. And business spending, as we know, will go down from about 9 to 6%. And we really believe that there's going to be slower growth for the earnings, too. The other thing is that the historical trend of low volatility often precedes a market pullback. And we saw a huge amount of volatility last year. Volatility was double what it was the last 50 years on average. But as of recently, we've seen a significantly less volatility, and I think we need to kind of be worried about that too. So really, we want to thank you for listening to our first quarter webinar, and whether you're a client or a potential client, we hope this was beneficial for you. And again, remember our referral program. Every time you bring in assets based on a referral, we add those assets to your assets, and you hit a different break point, even though your assets are the same, so your fees really, most of the time, get reduced. So we appreciate those. And again, if we can do anything for you, here's the contact information on people, their direct numbers to the All-Star team. But again, we want to thank you for everything you've done for us and entrusting your assets with us. And we'll look forward to a visit next quarter with you. Have a great day.